Asian markets are trading mixed this morning as trade concerns resurface. Singapore's economy unexpectedly contracted in the second quarter as exports continue to plunge amid a worsening global economy. You're looking at the benchmark STI as well as the Sing dollar versus the greenback, and we are seeing the financial stocks holding quite steady this morning. In fact, big bank DBS is up some 0.5%. OCBC also showing some gains of about 1/3%. We are seeing negativity among the manufacturing stocks. Venture Corp, for one, down about 2.7%. The Sing dollar also, you can see they're weakening against the greenback. President Trump also tweeting, complaining about China's trade policy, which sent the U.S. markets briefly lower, showing just how sensitive the market remains to trade-related developments. For more on all this, we're joined by Kian Soon, Chief Executive Officer and Fund Manager at Astral Asset Management. Thanks very much for coming in, Kian Soon.
Morning.
So we'd like to start off with the Singapore GDP, the advanced estimate numbers. How bad is this? Are we flirting with a technical recession here?
I think we definitely are looking at a technical recession. It came in flat this quarter, year on year, and this is way below the analysts' expectations of around 1% on the survey that they have done. And if you look at the whole situation, Singapore is a very trade-dependent economy. So in terms of a global slowdown, as what we are seeing across the world, Singapore will be very much impacted because we are trade-dependent. Our manufacturing has slowed down considerably over the last 2 quarters.
Is there any way that there can be some positivity trickling out from this, from manufacturing stocks, for example?
I think for the manufacturing stocks, we need to start looking at their orders again. I think it's unlikely to rebound in a very short term. Not to forget, the manufacturing stocks and companies have a good run last year. They came out on a high, and as a result of the trade tensions resuming beginning of this year, we are going to see a huge slowdown in terms of orders. The uncertainties in terms of the business world is, I will not place my orders up front. We'll see how things go. And this is very severe for the Singapore manufacturing companies and sector.
Well, Kian Soon, as you just highlighted and pointed out, quite obviously that Singapore is very trade dependent, and looking at the fragility of the economic backdrop, plus the fact that trade matters don't seem to be improving in terms of trade war. They seem to be worsening because we're looking at it now splitting across to South Korea and also Japan. Will that put the central bank, Monetary Authority of Singapore, in a tough spot when it comes to October? Because, I also want to talk about inflation, because if you look at Singapore, it is one of the most, if not the most expensive city in the world today. Couple that with a slowing economy, what do you think the central bank, or how do you think the central bank might respond in the October meeting?
I think in the coming October meeting, it's highly likely that the central bank will not put the Sing dollar on the appreciating path as before. It's likely to see a flat or more conciliatory kind of path, so that the Sing dollar is not as strong as before. So in terms of what the market looks at in terms of Sing dollar and USD, we're looking at a 1.38, 1.39 regions.
And what does that mean for the knock-on effect with saying pricing of interest rates here in Singapore, and of course the knock-on effect tethered to the sectors that benefit from lower interest rates, such as the REITs?
Okay. In terms of our pricing or interest rate, is actually we are very much dependent on what the Fed measures are going to be end of this month. I think from the interviews we have heard from Jerome Powell the last 2 days, it's very likely that the Fed actions will be dovish, i.e. they're going to reduce the interest rates. Market have priced in a 25 bips reduction. In terms of the effect for Singapore, I think if you look at property developers and REITs, these are players that are very finance heavy. They have a lot of debts, and a reduction of interest rate generally goes well for the Singapore REIT sectors as well as the property developers. I think we have seen the prices of the Singapore REITs counters going up a fair bit, especially in the last month. And I think the market have already started to price in the actions of the Fed.
So is there further upside, you think?
I think it depends on, is it going to be a one-time reduction of interest rate, by the Fed, or is it going to be, a 2 or 3 times, reduction following the until end of this year? If it's more than once, and we are going to see a interest rate reduction journey along for the full of 2019, Singapore side will have to follow in terms of SIBOR rates reduction. In fact, you might actually look at a mortgage rate reductions for everybody who has a home loan.
Oh, right. Great news. Okay, well, what is this going to mean if say, the Fed is not going to just do a one-off insurance cut and there's going to be a new trend? And in fact, if you take a look at the narrative from the European Central Bank, you can sort of gauge where they're heading. And of course, we're going to get another new central bank chief with Christine Lagarde potentially, right? And everybody, the market's pricing in that she'll be dovish as well. So if we are heading down back towards the land or the realm of QE, you know, QE 2.0, what do you do in terms of allocations when it comes to asset classes here, and also geographical allocation? Because at the moment, the U.S. is the best game in town.
In terms of geography, I think the U.S. economy has been resilient despite of all the trade tensions we have heard. I mean, last night we saw that Dow Jones have surpassed 27,000 points. You know, S&P come close to 3,000 points. You know, market is, you know, roaring red hot, if you ask me. And truth be told, the Fed does have more monetary policies ammunition than ECB and Japan central banks, if you look at the big central banks of the world, because they have actually been raising interest rates the last year in 2017 and 2018.
And trailing off the balance sheet as well.
That's right. So they do actually have more ammunitions. Implications for asset allocations, I could think of a few. The first is bond yields is going to go down, right, as interest rate declines, and bond prices are going to go up. So in terms of finding better bonds to invest, investors will have to trade more risk in order to get a higher yield. Secondly, I think in terms of money moving around, there would be money moving to equities, because if you look at fixed income with having returns of less than 2%, it's not actually very attractive for a lot of investors. So we'll see allocation shifting back to the equities market, and that will be good for the equities, global equities market, because you're willing to have more risk to have a higher returns.
Right.
But with all the uncertainty, why would that make sense, actually?
With all the uncertainties, we see that the U.S. markets have been, you know, roaring very hot. And if you look at the equities market, I would say there are actually areas where there are pockets of growth, as well as is rightly valued. If you look at NASDAQ, it's valued at 33 times PE, right? S&P, 20 times PE. But Asians markets are rightly valued, because if you look at Hong Kong, they're trading at a P of 11.7 times. And at the same time, they have very good consumers growth. You know, they have very good, reliable economic growth in China, around 6%. And that would actually help in terms of providing diversifications in terms of allocation. In terms of money movement, with interest rate declining in the United States, it's very likely that the US dollar will start to depreciate. And that will actually move money back from the developed markets back to emerging markets. Okay. And so it's an exciting time for Asia as the money actually moves back to the emerging markets, as well as with the MSCI readjustments of China allocations. We're going to see more interest in equity markets in this part of the world.
All right, sounds good. Thanks very much for that, Kian Soon.
Like we should be buying China because of the valuation gap.
Moving in. Kian Soon, CEO and Fund Manager at Astral Asset Management.
Right, we're headed for a quick break. Now, up next, he's known for his creative food pairings in his Michelin-starred restaurants. So what does experimental chef Heston Blumenthal think of local hawker fare? We'll tell you more on CNA Plus.